All right, let's get right into it here on this week's today's video, spider analysis, and well, market is down about 1.3%, 1.4%. It was close to down 2% earlier today, as you can see. But with that last hour ramp here, we do have a bullish engulfing candle on this 65-minute candle there on the last hour. What happened was, though, I think just based on how it closed, bulls really trying to save that ball, because what happened was, you see that midterm moving average, right? The midterm moving average has been that crucial key moving average. As you can see here, that's dotted blue moving average right there. As you can see, once it was reclaimed, right there, you see that how it's been acting as resistance here. It was slightly below it, the midterm moving average. Of course, it was my long-term moving average there to save the fall. And then we gapped above the midterm, right? And this was like a late January or so, or mid-January, rather, mid-January. We retested midterm, and as you can see, this market thrived for at least a week and a half or so. And then when we did see another downturn, and this was early February, I mean, technically it was January 31st. This was the one-day downturn. And I believe this was 1.5, 1.6% decline. So technically speaking, this decline here on January 31st was a bigger decline than what we witnessed today. And obviously on an intraday basis, we did go down to 2% today. And on the January 31st, it really ended the day in a weakness. Not only we had this pretty sizable down gap that remained open, we flushed down on the last hour. So it closed the day with extreme weakness. But then next day, you see how quickly things turned around. So you have to understand that the market, its trend is not going to be established. Downtrend cannot be established with, one-day downturn. And that's sort of what I was talking about on this chart right here, right? So as you can see, when we look at, this is a daily chart. When you look at this, we can see that you see there's a down gap. There's a down gap. There's a down gap. A lot of people ask me, like, there's no down gap. There is a down gap, because remember, this is where it closed. So when you see a green candle, at the top of is the green body, that's where it closed. And when you see a red candle, top of the red candle, that's where it opened. So you don't see physical gap like this here or here, but there's a gap, because that's where it closed and it will open here, right? Gaps are important, especially when the gap doesn't get filled. And of course, back in August, September, October, the gap never filled. Gap never filled. Gap never filled. But what's important is not just one day down gap and a bloody day. What's important is continuation to the downside, the follow through.
20 minutes later.
So you see that how when bears operate, they don't like to hang around so much. They don't like to move sideways. They like to go boom, 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 boom. That's how bears operate. Bulls, they like to make a move and like consolidate. They like to move inch by inch, step by step. They'll have like big down updates, but it'll consolidate for another month or so. That's how buyers operate. So if you understand their operation, their characteristics, then you can gauge what might be the outcome going forward. Because, okay, yes, we have one down day, right, with the down gap, which we've seen it here. One down day with the down gap. There's a down gap. There's a down gap right there, right here. But nothing, there's no follow through. There are no bloody follow through. There are no big, red, intimidating, painful, fearful, long red candles. So what bears are looking for, if you're a bear here, you're looking for this market to see 5 to 10% correction from here. We could potentially see, you know what I'm saying, like a bear flag or something like that for a day or two. But you do need to see this down gap holding. Make sure the down gap does not get filled. And you do need to see that flush. You do need to see the secondary bloody candle. More is better, because that's how bears operate. They want to see this thing coming down as quickly as possible. If you start to see the market sort of like bottoming, consolidating, resting, sort of lethargic sideways, especially in this roaring bull market we've been in the last 3 months and a half, that's when you know bulls are just preparing for another leg higher. And now we're looking at 65-minute chart. You see that midterm that acted as support. Again, it does have an impressive resume because it acted as support here. It acted as support here. We broke below it briefly, but bulls saved that ball on the last hour because bears need to break below the midterm moving average, that dotted blue here, to reclaim that midterm moving average, to reprogram that midterm moving average to support the sellers. Now that bulls made that last hour ramp here, that midterm still belongs to the buyers. It still support the bulls.
Perfect.
However, the micro term and the short term, their both have been reclaimed and reprogrammed, and there for the sellers. So in the short to micro term, we do need to give benefit of the doubt to the seller, as long as price is below the short term and the micro term. So if we do see a move to the upside tomorrow, just based on the fact that you see that long bullish candle, the micro term, the short term will act as resistance. Bulls need to reclaim and reprogram. What happened was last time, you see right here, that's a micro term, that's a short term. So micro term is aqua, short term is green. We flushed through right here. But what happened next day? Next day on the third hour, remember we talked about this? Third hour, fourth hour, all the battles were fought on that third hour, fourth hour, reclaim the micro term and the short term. What happened, bull? So if we see on the, and remember this down gap, there's down gap here. The down gap was fully filled quickly. So if the micro term, especially in this market, if the micro term and the short term gets reclaimed tomorrow, bulls are going for to fill this entirety of this down gap. Exactly what they did on February 1st and February 2nd.
Yay! Yay! Hooray!
So with this kind of candle right here, however, I wouldn't be surprised to see a down gap. I'm not saying it's going to happen because nobody knows how things are going to play out tomorrow morning. What I'm saying is, I wouldn't be surprised to see this thing opening somewhere right here. You know, this market it's gonna, just think about like, okay, just psychologically speaking, right? Just think about the psychology, the sentiment of the overall market when this thing closed on bearish note. You see that long flushed Maru Bozu candle, right? That was the last candle on that day. January 31st. People are bearish. People are bearish, right? But today, people are bearish. But what happened? It gapped up. So the market closes extremely weak with the long, bloody red candle, and the next day gaps up And then 2-3 hours later, it reclaims the micro and the short term, and the market just goes straight up vertically. So remember that. So today, why do we have this candle all of a sudden, right? So if we do see another secondary down gap, because remember, throughout this entire move since the October lows of last year, those down gaps were quickly filled. Remember, I looked at the daily chart. A lot of these down gaps was not sustained. So can you imagine for the first time since the October lows of last year, not only this, and that's a sizable down gap. Not only this down gap remains open, can you imagine if we see another down gap here, the secondary, and market open somewhere here? And then this thing coming back down to retest my long-term moving average. So if we see a down gap and the down gap does not get filled right away, we're going to see a continuation. So it will be very, very important how this market plays out tomorrow. As you can see, we're now getting to that level here, which is oversold zone. The oscillator as of today has not crossed back up here, as you can see. But we entered oversold zone without that oscillator crossing back up. So if we do see a follow through to the upside tomorrow and reclaims that micro term and the short term MA, and then bulls are going after filling this down gap, that oscillator will cross back up, and this is the level to do it, because that's exactly what happened here, that's exactly what happened here, that's exactly what happened here, though there was bullish divergence. This was back in middle of January, we saw bullish divergence here. If we see a abrupt downturn to the downside tomorrow, and bulls are going after 488 here in the long-term MA, coinciding with my 50% retracement around 488, 486 or so, that oscillator is going to continue to travel down. It has room to do it. We just entered oversold zone, but not at the extreme oversold zone. I'm going to come back for you. We'll reassess the situation. Enjoy your evening glove trading tomorrow.